It is the final trading day of 2023. And as we prepare to end the year with a bang, we also have to set ourselves up for what could be a wild 2024, with geopolitical tensions showing no signs of cooling, a potentially contentious election on the horizon, and inflation remaining sticky. Our next guest has his eyes on the risks. We have Bob Elliott, Unlimited co-founder, CEO, and CIO with us. Now, Bob, one of the risks you've cited is markets pricing in up to 7 rate cuts in 2024. So let's get your perspective on this. What are you expecting from the Fed? Are you in the 7 camp?
Well, I think the odds that we see that magnitude of cuts from the Fed are pretty low. And the reason why that is central banks move quickly to respond to growth slowdowns. They don't necessarily respond swiftly to inflation moderating to around their target. And so a lot of the short rate market is expecting the Fed to see that lower inflation, that stabilizing inflation around 2%, and quickly cut in response when there really is no urgency. From the Fed's perspective, what they see is an unemployment rate at secular lows. They see growth above potential, and they see inflation that's around their mandate. And you put that all together, there's no urgency to make any moves, let alone cut 7 times.
So, Bob, make it make sense for us here, because you would think if the Fed does end up having to cut, albeit I don't believe it'll be 7 times, but if they do, what does that mean about what's happening in the economy that would have led them to cut 7 times that the markets are not factoring in?
Well, I think anytime the Fed quickly cuts interest rates is a time you don't want to be holding stocks. And so I think there's a real disconnect between what we see priced in the stock market and what we see priced into the bond market right now. Stocks are pushing new highs, reflecting the fact that there's a strong set of liquidity conditions, and the fall in long end rates is actually on the margin stimulative to the U.S. economy. And then on the flip side, when you look at the bond market, and particularly the short rate market, there's a greater than 30% chance that short rates will be below 3% by the end of 2024, currently priced in. Those two things are totally out of whack. The only way in which we're going to see interest rates get cut that rapidly is if we have a meaningful growth slowdown, and a meaningful growth slowdown like that would be terrible for stocks. And so I think when you look at that mispricing, the imbalance of pricing looks more incorrect on the bond market side than it does on the equity market side. We've seen a few swings of this over the course of the last couple of years, where there's continually this expectation that the Fed's going to cut, the Fed's going to cut, the Fed's going to cut, but it never actually transpires because the economy ends up being meaningfully stronger than what people have expected.
Bob, before we came to you, we were kind of talking ahead of you about the things that strategists, analysts got wrong for this year. One of those things was recession prediction. So how do you think, from what you're saying, basically, it looks like the bond market is, or the fixed income side of things is predicting incorrectly what the Fed will do. So what's your expectation for what the economic backdrop will look like in 2024?
Well, if you think about where we were before the last 8 weeks, we were seeing above potential growth, some moderation from the relatively strong growth earlier in the year, but still doing pretty well when it came to the growth figures. Consumer demand was holding up. Employment conditions continue to be relatively strong. And then in the last 8 weeks, we've basically gotten an effective 100 basis points of interest rate cuts on the long end, and we've got stocks up, in double digits, both of which are highly stimulative to the economy. So if you look at that picture, coming into that, a pretty good growth trajectory combined with additional stimulation, much more stimulation than was probably necessary for the economy. The odds that we go into a recessionary dynamic, say in the first half of 2024, are very low given that setup.
So, Bob, given what the markets are telling us, the bond market and the Fed clearly saying, don't get ahead of yourselves, how do you play this sort of market? How do you play the opportunities in this environment?
Well, I think we're going back to an environment that looks a lot more like where we were at the beginning of 2023, when there were a lot of expectations of very weak economic conditions, which obviously didn't play out as was expected, and where the bond market today basically looks like where we were back then, and with expectations of a relatively swift move to cuts, I think we're going to see a replay in the beginning of this year, similar to what we saw in the beginning of 2023, where stocks outperform bonds and where the strength of the economy continues to get priced back in, and those interest rate cuts that are priced into December 2024, those are going to come out. Bond yields are going to move higher, and stocks are going to hold up in that environment given the strength that we're seeing. So it's a good time to be long stocks relative to bonds, and in particular, short those short rates in the December 24 period.
We'll have to see how all of that plays out. So far, it doesn't seem as if anyone's getting that right. Appreciate you joining us this morning, Bob Elliott, Unlimited co-founder, CEO, and CIO. Thank you so much.